I'm also tracking the moves in Manulife. Let's take a look at the graph. It's trading above $28 per share, something it has struggled to do, quite frankly, since 2008. And part of the catalyst is what it announced yesterday, announcing a $13 billion deal to reinsure some of its book in the long-term care part of its business. Now, in doing so, they are rewarding shareholders with a share buyback. It's one of the reasons RBC upgraded shares of Manulife today, putting a $34 price target. And here we are looking at the stock trading above 28. Joining me now is Gori, President and CEO of Manulife. Roy, thank you so much for being with us.
Good morning, Amber. It's great to be with you. Thank you for having me.
Let's talk about this long-term care business, because we think about you as sort of a life insurer and really what the challenge is with long-term care and why it was critical to kind of move it off of the Manulife books.
Well, we were delighted to announce yesterday this transaction. And it is a major milestone in our company's history, quite honestly. And that milestone really is about transforming and reshaping our company towards lower risk and higher return. So it was a $13 billion transaction in total with Global Atlantic. And a big part of that was the long-term care business, in fact, $6 billion. And it makes this transaction the largest LTC or long-term care transaction in history. Now, what's been a drag on our stock for several years has been uncertainty around long-term care assumptions. It's been a drag for us, but it's been a drag for the entire industry. And through this transaction, we feel that we've been able to validate the prudence of our reserves and therefore give confidence to the market around the quality of our book and the quality of our reserving, which is, we believe, a key factor in driving a re-rating of our stock. And again, we think that there's much more to be done in this space. So we're quite optimistic about the future.
I think that's the question, because for a long time for investors, they didn't think anything could be done here. And you were able to do this with part of your book. Are you currently working on another deal like this? Might it be on similar terms?
That's a great question. A couple of thoughts. Firstly, this is quite a significant percentage of our long-term care book, in fact, 14%. So it's not insignificant. And as I mentioned earlier, it's the largest LTC transaction. And then the question is, why now? And I think it's a combination of three big things. The first is that we've got a maturing of our portfolio. We now have much more data that helps support the assumptions that we're using to predict our reserving. And just a couple of data points that I'd leave you with is that we've seen the policy count on this portfolio reduced by 16% since 2018. And we now have, in fact, less than 50% of policies that were originally sold that are still on our books. So the first thing is that the maturity of our portfolio has developed quite significantly over the last 3 to 5 years. And we have much better quality data that gives much greater confidence in the assumptions and therefore the outlook as it relates to how this business will continue to unfold. The second big factor was that our experience with this block has been actually very good. We look at our performance on a monthly and quarterly basis, and it's been very consistent with what we're expecting. And then finally, we've been putting a lot of effort into organic actions to help manage this business as well as we can. One example of that is the use of advanced analytics and AI to really improve our fraud detection capability. So I think it's a combination of those factors that have really facilitated this first transaction. And I think it's going to be a catalyst for future transactions.
And just to underline kind of what we're talking about, when you're a life insurer, and because you're talking about data, it's so crucial here. When you're a life insurer, you have all kinds of data to estimate mortality. Long-term care, as I understand it, the data is a little bit more complex. You don't know when somebody's going to fall ill, or you didn't know as accurately as perhaps you do, I guess, on the mortality side. Am I explaining that correctly?
You're broadly right. You know, we're in the business of taking risk, and we're in the business of taking long-term bets. And we use data to help support the confidence that we have around how those assumptions will unfold. So the more data that we get, the better the ability to predict the outlook and the future. And again, for this block of business, it's been historically quite young from a relative perspective. And now we've reached, I think, a tipping point where the data now really supports the quality of the assumptions that we've got. I'd also say the one thing that we're quite unique with is that we typically, in Canada, update our reserving very regularly. That's not necessarily the case everywhere else in other jurisdictions. And then our regulator, OSFI, requires us to not only have our own view of what the assumptions will look like, but OSFI requires us to have an independent peer review of our assumptions. So that really makes us very confident that our assumptions are prudent. And again, this transaction has validated the prudence because we've got a third party that's willing to transact with us and has pretty much validated that what we've predicted for the future is the way they're looking at the business.
Do you have a timeline of when, it sounds like there could be something else. Do you have a timeline of when another deal like this could be announced?
It's hard to predict the future, and I won't speculate on when we do transactions, but we've been on a huge journey to transform our company, as I mentioned earlier, and we've been very effective over the last 5 years at doing exactly that. In fact, over the last 5 years, we've freed up more than $10 billion of capital. As a result of that, we've improved the ROE of our company from about 11% to almost 16%, 15.7% in Q3. And long-term care and variable annuities has gone from representing 24% of our earnings to, with this transaction, now only representing 11%. So we've been very active inorganically with divesting those blocks of businesses that are higher risk, but also have lower ROE and returns, and deploying that capital to higher return businesses or returning it back to shareholders through buybacks, which is obviously a key way that we create value for shareholders. And we think that there's more for us to do on that front.
And certainly you announced it in conjunction with this deal. On the call that you were on yesterday with analysts, there were questions about how this affects you. You mentioned your return on equity. You're trying to target a higher number there. How does this affect something like earnings growth, dividend growth? Is it all sort of directionally positive?
It is all very positive. So because we're deploying all the capital that we're freeing up from this transaction towards buybacks, it means that this transaction is accretive to earnings per share and return on equity. So we think this is a great outcome. And it's really a function of the fact that we traded this block of businesses, which again, in aggregate, have a return on equity of about 10% when the total company's return on equity is closer to 16%. And we traded that at a multiple of earnings of about 9.5 times. So that's a great way for us to, again, create value for shareholders through transacting these blocks, which are higher risk and lower return.
I felt it was important to kind of get into the weeds on this deal for shareholders, especially long-term shareholders in Manulife. I kind of mentioned that $28 per share, Roy, on the stock. It has been a stubborn lid, right? And you know that. It hasn't been able to go meaningfully above that since the financial crisis. And are you thinking about this? And I know executives don't like to obsess over the stock price, but are you thinking about this as kind of leaving a chapter behind, creating a base to kind of do well by long-term shareholders?
Well, I think you hit the nail on the head. Our focus is on creating value for shareholders over the long term, and it has to be sustainable. There's no real reason or any value in creating anything that might give us a short-term benefit, but not driving sustainable long-term value. And yes, long-term care has been the biggest drag on our share valuation and multiple. And we do think this is a catalyst for change. We're quite optimistic about the value we can create from a shareholder perspective. Our dividend is very attractive at approximately 6%. We've got incredibly strong leadership positions in North America, both here in Canada and in the US, with some great businesses where we're leaders driving great growth at great returns. And we've got the phenomenal growth engines of wealth and asset management and Asia. So I think we're a pretty compelling argument. And in this current world where we are going to see maybe slower growth in certain geographies, having the diversity of a business that spans multiple geographies and a business that's going to benefit from higher rate environment, I think we provide a pretty compelling argument for why we should be an investment choice, especially now with this transaction done.
Yeah, let's talk about that higher rate environment. If you'll permit me a macro question, that's kind of the macro question of the day. The view that we're done with rate hikes, the market pricing in rate cuts. How do you think about that as somebody who says, we're positioning for a higher rate environment?
Yeah, well, I think what we've experienced over the last 18 months is central banks really fighting inflation and wanting to get inflation under control. And with that has come a lot of uncertainty and concern. Folks have not really had a clear view on how high rates will need to go to contain inflation and how low inflation will need to come before those higher rates start to kick in. What's encouraging is that we've seen inflation slow and now we've started to see it actually come down. So there is, in my mind, a view that we're going to see less hiking of rates and possibly even a few cuts. Inflation is going to be, I think, stubbornly stickier than it has been in the past. And as a result, I think we're going to be in a reasonable environment from a rate perspective, but rates will be higher than what we've seen over the last decade. And quite honestly, the last decade has been more unusual than when you look back further. Rates were almost at zero and money was free. So that wasn't necessarily a realistic scenario. And I think what we're moving to now is going to be an upward sloping yield curve. We might see the short end of the curve come down a little bit, but it will be a higher rate environment. And I think that's manageable. It might result in a slower growth environment, but I think that's something that can be navigated.